Hello traders, welcome back to Liquidity Narrative Classroom this week. Um, we start this week. Do you actually know that price is always telling a story? But most times we traders we don't really know how to read the story that the price or the chart is telling you. So look at it this way. Imagine that you're reading a book and where every page is out of order. Probably you looking into the book and you saw page one and then moving to the next page is like page 12 or thereabouts. The story won't connect, right? You won't understand the story properly because every page is out of order. And trading is exactly that way. Remember, we always say that the reason for this is not like is it born out of passion for this channel, is born out of passion to help people understand to the least or as simple as we can with the help of God, how to understand the market better and not rushing the process. So just like we said in the scenario, reading a book that is out of order, you won't understand it. So we say trading is also the same way. Trading is exactly the same way. Every candle you see in a chart is like a word in a coded language. So every candle you see, all these candles you see in different time frame on your chart is a word, but it's just that it's written in a coded language. It's not like the plain English or French or Japan that you speak. So every swing, be it swing high, be it swing low, is like a sentence. What do I mean like every swing? When we look at this area, you can say there is a swing low, swing high, all these ones. So they're like a sentence. And you know, when you put the words together, you get sentence, right? That's why I said every candle is a word. But put them together, they are telling a story. There is something that they are telling you. So if you read it correctly, you'll be able to understand exactly what the market story is. So together they tell a story. And the story that is being told by this market is what we call the market structure. Is what we call what the market structure. We want to understand what the market structure is. Like we said, is telling a story. So today, I'm going to teach you market structure in the simplest way possible with the help of God. It is not by man's wisdom. So I'm going to teach you that in the simplest way possible. And once you understand this market structure, you will start seeing the charts or the market in a different way. You will start understanding better, and then your market studying or analysis will be different from the everybody out there, from the rest of the world. So if you cannot read this market structure, it means that you are simple gazing. You have to understand, you have to be able to read the market structure. You know, it's one thing for you to read something, it's another thing for you to understand what you are reading. So we want to combine them together, the ability to read and know, yes, you can say this is a bearish candle and this is a bullish candle. That means you are reading it. But if you don't understand it, putting them together, it doesn't really make much meaning to you, right? It's just like you're reading words without meaning. So this is why market structure is one of the most important skill every trader out there must learn. If you learn the structure, it will help you in a big way. You have to learn structure before you start talking about learning the other block, before you start learning about the fair value gap, the price action that we're talking about, before you start looking out for entry patterns or your entry. You must first understand what the market is saying to you, what the market is trying to let you see. So you have to understand all this, and that's why we put it bit by bit, building block by block for us to get a bigger building. So this week, what is our learning objective? We've said, yes, we are talking about market structure. What is the learning objective for this week in Liquidity Narrative Classroom? So like most of the topic, we'll just be using the charts for clarity purposes, while some other ones we have to use probably the blackboard or your whiteboards, because it has more of something to put down or read. So the learning objective first for the exam. At the end of this lesson, I want you will be able to understand what market structure is, why market structures matters, the bullish structure, the bearish structure, the ranging market, how structures works with liquidity, and then how the institutional or the professional read the market. So these are the things we want to look into: what market structure is, why market structure matters, understanding the bullish market structure, the bearish market structure, the ranging market. Remember, we talked about last week on a consolidation, which is also like a ranging market where you don't have really a direction. Then how market structure, how the structure works with liquidity, and how the institutional or professional reads the structure. That having been said, let's jump in. So the first thing is, what is market structure? What can you say is a market structure? The simplest thing we can say is the way market structure is just the way price moves overall. Look at this chart. We are in a day chart. Between this line we mapped to this line we mapped, or this even this one we've mapped, how is the market moving in overall? That's it. So if you can be able to rate how the market is moving here in overall, you'll be able to say, okay, this is the structure. We are in a bullish structure, or we're in a bearish structure, or the market is just ranging. Yes. So here we can see that the market between this and this, you can apparently say that the market has been making higher highs. Look at it. Then at some point here, we have this ranging structure. Market not making high, not making lows, not giving any particular direction. Between here and here, we have this ranging structure, which we talked about last week. If you haven't gone through the last week class, you probably have to go back to it. It will be of help to you connecting the dots. So you can see from here to here, we say this structure is actually a bullish trend or structure, market structure. Then if you move, or we can see all these ones are all bullish, has been making bullish structure. So between also here, we can see that the market in this particular area has been a bearish structure, making lower lows. So breaking the previous lows, creating another lower point. Then within here, we can also say there has been kind of a ranging market. There was no clear direction here. So you see the three things we talked about: the bearish, the bullish, and the ranging market. You can see them all playing out in that. And mind you, this is a higher time frame, the daily time frame. So you can see them being played out. We've talked about it. So market structure is simple. The way price moves overall. In overall, how is the price moving? That is the thing you should understand. Price, we said that price either move in a price either moves in upward direction like higher highs, or moving in downward directions like lower lows. We've said price never moves in a straight line. You won't see price moving from this to this in a straight line. No, price doesn't move that. It either creates a swing high, or it's creating a swing low. So these are like here we have a swing high, a swing high. So price is swing high. These three candles, one being higher, the two other are like not so, not higher than the other one. So creating a swing high, a swing low, the same way here. That's what price is always doing. So by studying those swings, we can understand who or what is currently, or what the current trend is. You see the market after making the swing low, it's broke out of this swing high, creating a new highs. The same way, broke out of this also, creating a new swing high. So you understand the trend. It helps you to understand the current trend of the market. So think of market, or think of market structure as the market's language. Instead of listening to opinions, So we listen to what price. This will be of help to you. You don't listen to people's opinion like, oh, okay, we're buying, we're selling, all those opinion that people are putting out there. You take time to study the language of the market. It will really be of help to you. I hope so far so good. We've been able to make sense in this particular saying. So instead of listening to opinions, we listen to what? Price. So simply we said that the market structure is simple, the pattern of highs and lows that price makes over time. That's just it. The patterns of highs and lows that price makes over time. It's like the skeleton of the charts. It's like the big picture story. So you know this is a chart, the skeleton is building up something, is giving you something to build on. It's giving you, okay, this is a skeleton, we're making highs, highs. That means I should be looking at for more of a sell than buying for you to build your trade on. That is what we said. So simple, the pattern of highs and lows that the market makes over time. That is just what market structure is. That having been said, I will say this, think of it like you walking in a hill or in a staircase. You're walking, then you take a step forward. This is you taking a step forward and you pause. Remember, when you're walking through the staircase, you don't jump with your two legs. One leg have to go over first, the other one is still at the back. So the same way, that's how it is. You walk, put another leg up, and one is still behind. So the market is doing the same thing. You continue climbing, so price behave the same way. It's doing the same thing. It pushes up, then pull back. It pushes up, then pull back. As long as each push reaches a higher point, the journey continues upward until we get to a certain place, right? Until we get to a certain place. So we keep moving. That is what we call the bullish market structure. Yeah. So the bullish market structure, market is making higher highs. You can see making higher highs and then making higher lows. It pushes up, it pull down. This is a higher low. This is a higher high. In simple times, price moves up and then price pull back. Price moves up, price pull back, but doesn't fall below the previous important low. Remember, I said the previous important low. This is important low. This is important low. When this pull back, it does not break this. So we said we have bullish market structure, right? In the same way, what do we call or what are we looking at when we talk about bearish market structure? That's like an opposite of the bullish. So in the same chart, let's go back and find out where we can get our bearish market structure. Okay, here is exactly pure example. Look at it. So the market actually creates a lower lows. That means it's lower than the previous low. And then it creates a lower high. This is it. The market, the price falls and then pushes back. It falls, pushes back, fall, pushes back. Even when this push up, it did not apparently take out this major lower high completely. You can see it. It pushes one corrected almost to the edge of it, but didn't create it. This is an important pullback. So it pushes again. That's it. Because it pulled back, but cannot reach the previous high. It did not take it out completely. Then it sells, pushes back again. So each new low shows that the market is what? Bearish. Each new low shows that the market is what? Bearish. Each new high shows that what? The market is what? Bullish or is becoming weaker. That's so also imagine you're walking in a staircase too. You don't jump down from the staircase. We use the same scenario so that it will make sense. You don't jump down with your two legs in the staircase. What you do, you put one face and the other one is still up. You put another one down and the other one is still up. That's just the same thing the market is doing, the same thing. You are not moving or jumping directly with your two legs. Market does the same thing. One leg down, one leg up. But the first leg that move shows you that's the direction of the market. While the one that remain up is like the pullback of in the direction of the market to give others opportunity or for you to get the strength to take the other leg up. That's just it. After this, the same leg pushes back. So we said what is a bearish market structure. So now you've understood the both market structure. Then in the previous class, we also have what we call the ranging market or the consolidation market, where price is moving sideways. It wasn't making highs, it wasn't making lows. There is no clear direction. This is what we call what? A range or consolidation. So if you remember our previous lesson, we said consolidation is like a preparation. So let's dive in and also find out. You can see, like we said, market has been consolidating here. There's no clear direction in this place, which we've also taught in the previous class. All these things are important to your understanding or learning of trading. They are very important. So you can see the market consolidating here. There's no clear market moving high or moving low. It's just in a range until that range is being broken out of. So during a range, liquidity builds. If you want to understand more about this, we did a thorough class lesson on it just last week. So go back, search for the video on consolidation and go through it. We said that the consolidation is like a preparation. You can see the market preparing as in gathering liquidity. That's just it, building up liquidity. The institution they are preparing. We said that they are either exiting their trade gradually or building up their trade gradually. So retail traders, they becomes impatient with deal ticks completely and totally in the previous class. And eventually the market chooses a direction. You can see it. Eventually the market broke out and start making, this is another consolidation market did here. The market started consolidating again. Mind you, this is a higher time frame that we're using. So you can imagine what this is for this example. After that, it chooses a direction, continue in its direction that it has started already. So eventually markets choose a direction. And the direction is not by mistake. There is always a footprint in the chart for you to understand the direction of the markets. So the next question is this, which we've said we've mapped out at our outlines what we wanted to talk about. We've talked about the bearish, we talked about the bullish, we talked about the ranging. So the next one we are looking at, why does market structure matters? Why not just start teaching entries, buy, sell, or give signals? Why does the market structure matters? All right, we can say market structure simply, it tells us what the market is currently doing. We've said that before. So when I say this, I know the market is more like a buy market, it's a bullish market. It's not what the market did yesterday or what the market is going to do tomorrow or but what the market is doing as I'm watching the trade or what the market, this is what market has been until there is enough reason to tell me that this market has changed from going to the up, now is looking to get down. That is it, what the market is doing. Should I buy? Should I sell? So what you're going to ask yourself, what is price currently doing? When you enter into your chart, when you get into your chart, the first question you ask yourself, what is price currently doing? So if price keeps making higher highs and higher lows, then we say that the market is bullish in nature, just like we've been able to define here. If price keep making lower lows and lower highs, then we know, like we've also defined or shown in the previous example, we know apparently is a bearish market. So price speaks first. Our job is to listen. I hope this makes sense. Price speaks first. Our job as traders is to listen. What is the price saying? If you listen attentively, it will tell you something that will be of help to your trading. Yes. Now you've known what market structure is. The reason for the market structure is trying to tell you a story, asking you to listen. If you listen hard enough, you'll be able to get exactly what the market is doing. You take advantage of it. Moving on, well, we said what's the next thing we are looking at now is about the market structure and adding up liquidity, how they work together. We connect this to what we've already learned. So we remember that price seeks liquidity, which we've also taught in this classroom. But the market structure helps us to understand how price is likely to reach to that liquidity. You see? So we are connecting market structure and liquidity, how they work together. Again, I repeat, price seeks liquidity always. Price is always seeking for something. It's seeking for where liquidity lies. But market structure helps us understand how price is likely to reach to that liquidity. Market structure is like the process of how price or the channel price used to reach to that liquidity. The step that price takes to reach to that liquidity gradually. The question is, where lies the liquidity? How am I going to be part of benefiting from the liquidity? So you see, let's take for example, imagine that price is making higher highs and higher lows, breaking up the previous high. So above the recent high lies the buy side liquidity. Let me explain. So this is price making higher highs. Here lies what? Buy side liquidity. There is no reason to immediately assume that the market will reverse. No, the market is making higher highs. So I know that liquidity lies here. If this market gives me an opportunity to join, I know the market is seeking this liquidity. It's going after this. So this is what we said. This side is the buy side liquidity. So instead, the market may continue its bullish structure until that liquidity is reached. There's no reason for me to think it's going to reverse immediately for a reason. That will bring in something. So you see, the market pulled back and took out this liquidity. The same way pullback took out this liquidity. The same way until we had this area of consolidation. You see how the market is connecting together liquidity and market structure working together. So liquidity gives us the direction or destination where the market is going to. We now know, that's what we said, draw on liquidity. What is drawing the market? Something is asking the market to come back this way. Our market is trying to reach to that particular level before it could maybe reverses to seek another liquidity. Market is always seeking liquidity. Liquidity gives us the destination. Market structure tells us the direction of travel, if I may put it that way. So we know apparently, okay, the market has been on a highs, higher highs. Let's take for instance, remember this is a very high time frame, like the daily chart, and you get opportunity to be in this trade using the lower time frame. You know, apparently, market will be seeking to get to this level. You can imagine what you will get by entering somewhere here, and then seek to leave here, and then you take another trade here, and then knowing that the market is reaching for this from here, you are leaving here. Remember, this is a higher time frame, like I said. So liquidity gives us the destination. We know liquidity lies here. That means, and then the market structure has informed us that this is the way the market is going to travel. It's going to travel to the upside. My own research is to find out where will I join this to make this journey to the upside until I get to this place to exit the market. So it gives us the direction of travel. This is why both concepts must be studied together. Study your market structure, study your liquidity, realize the liquidity. What is the market apparently seeking in all these things? It will give you a better understanding perspective in your trading. Add them together. I hope this is making a lot of sense. So having said that, the next question is you might actually ask yourself is this how to use the market structure? How do you use this market structure? Okay, let's take a look at this level that I've mapped out to this level or to this level. Apparently, let's go to the maybe weekly time frame. You always see this in my chart, in my analysis. You can see this level and this level, or apparently this level to this level, or even to this level. The question now is how do you use market structure? Always starts with a higher time frame, like maybe the daily, just like you've seen we did, or the weekly to understand the main story. Now look at if I'm starting from the weekly. Let's assume we haven't had this, we had this range. So this is like a range. In the weekly time frame, you know, we are not trading the weekly time frame. Maybe as retail traders, you might be trading weekly time frame, but I don't trade the weekly time frame. So before this was created, we have the swing high, we have the swing low. This becomes a range to me. If I drop on the daily time frame, what am I looking at? So let's drop on the daily time frame and see exactly what we have. Watch this level and this level. So within, remember we're using this bigger one. What's the daily time frame creating? It has already told me that this is what a bullish structure or a bullish market structure by creating all these higher highs, right? That's how to use it. You start from the higher time frame. You figure out this is a daily time frame. So I already know it's more like a buying market. So if I drop to my lower time frame, I'm looking for that opportunity to join the trade buying, not selling, because the higher time frame had suggested that this is what a bullish trend and not a bearish trend. You zoom in into the lower time frame for your entries. Remember, trade with the current market structure, not against it, unless you see a clear change of structure. If you do not see, just believe or know that the structure still remains the same. The question next is maybe how you're going to enter or the entry pattern to be using. But we said use the higher time frame. Always start with a higher time frame. Weekly can even be monthly if you are good enough with that. Monthly, weekly, daily. The minimum you can go is your full hedge. Use it. It will help you to see clearly, to understand the main story of the market, what the market is saying. Then when you get to the lower time frame, you have to zoom in into the lower time frame to start figuring out where your entry will be in line with the structure. You know, the biggest mistake or new traders or beginners normally make, and they make it over and over again. They will see one bearish candle and immediately start thinking that the trend has changed. Okay, let's take for instance, like here, if it dropped to a lower time frame, you will know we'll have maybe more a kind of change in structure in the lower time frame, or even apparently here, when this particular candle drops, we'll start thinking, okay, the trend has changed in our lower time frame. You see? That's how the people or the new traders sees that. They look at it as if the trend has changed. So likewise, whether one bearish candle, it does not create an uptrend. Neither the bullish candle here creates a downtrend. The professional doesn't judge the market by just one candle moving this. No, they judge it by the sequence of the highs and lows. Also zoom out and ask, what story is price telling? You see, I hope this is making a little bit more sense. So it's not by one candle moving down or this, or even two. Yeah, looking at it, what is the highs, the lows, the sequence of highs and lows, the structure that we have been. Look at this huge one does not mean we've suddenly changed. If you drop to a lower time frame, you will see apparently this might be like a bearish trend in the lower time frame. They don't judge it by that way. What they are looking at is the highs and the lows. Then you zoom out to ask yourself, what story is price telling at that particular point in time? So imagine price creating a higher highs and then a higher lows and then another higher highs. You won't call that bearish. No, you won't call that bearish. You can't call this bearish because market pull back here and then you can't say bearish. In your lower time frame, it might be bearish. But apparently this is a higher time frame, so we know it's bullish. It doesn't automatically change the market to bearish and not necessarily. Sometimes it's just a simple pullback within the same trend. This is a pullback within the same trend. And this is why patience is so important. We cannot overemphasize being patient in your trading. This is why patience is what's important. You wait for the market to reveal its story. Don't write the story yourself. You have to be patient. What is the market saying? We can know here the market is doing a bearish trend. So I'm patient enough to say, okay, this is a bearish trend. You wait for the pullback before you find a way to join the trend to the downside. Do not write the story yourself. All you have to do is to listen to the story that the market is telling you and be part of that. So before you enter or before entering a trade, the experienced trader always asks questions like this. Is the market a bullish trend? Is it a bearish trend? Is it a ranging trend? When you answer the question, you know what you're looking out for in the market. Are the market making higher highs, which we've shown you? Are the market making higher lows? Are they still being respected? Has the market started making lower lows? Where is the nearest liquidity? These are the questions you ask yourself. Is price moving towards that liquidity with strong structure or moving away from it? Notice something. I'm not saying what indicator should I use. Professionals doesn't use indicators. They are asking what is price communicating. You don't need indicators to be profitable. No. People build the indicator, right? Yeah. You can also be your own indicator by just using the market stories to be able to read the charts, and that is my aim. You trading without indicators, you being able to study these charts nakedly without indicator. I will always say, will you make mistakes? Yes. Will you have losing trade? Yes. But will you be profitable? Much, much better than any other thing. Will you be happier? Yes, because you are seeing the effort you have put in the market working for your own good. When there is a losing trade, you won't say, okay, it's because the indicator is this, I didn't watch. You just ask yourself, where did I get wrong? What didn't I see in the market? And that will help you to see more, clearer, better. So, what's our classroom exercise for this week or for today in this particular topic? Take your pen also. Let's take notes of this and go through it. This will help you immensely. One, you open your charts Now, remember, you're not thinking of buying, you're not thinking of selling. All you are going to do is to mark every swing high. You mark every swing low in your chart. You can use any time frame of your choice for a better understanding. Oh yeah, you're just studying this. So you mark every swing high, every swing low, every swing high, every swing low, every swing in your chart. Mark them. Now answer this question. Are the highs getting higher? One, or are the lows getting lower? Find out, just like we've done, we've been able to show this way. You move back or go to another chart. So you ask yourself the same question. Are the lows getting lower? Or is price moving towards sideways? Like we've also shown here, what's price doing? Is it moving sideways? Okay. Do this show, do you see them in every day? Maybe like if you're using the lower time frame or the higher time frame, check for it, how it has happened. Maybe sometimes you see it in a particular section of the market. You see a particular section of the market making the sideways, and suddenly this another section or trading time frame window has a move. Study this. Just do this every day for 1 week. You begin to read charts more faster, more clearer, and more understanding. And more importantly, you will stop relying on indicators to tell you what price is already saying without the indicator. Then you will stop waiting for someone in a particular place to drop a signal for you. Then you will stop waiting for someone to give you a pinch of fish when you can actually get into the river and fish as much as you can. You see, it's that simple. So, what are we saying? Remember this, let's summarize. Market structure is like the foundation of price action. It tells you what the market is doing, overall market control. Is it bullish? Is it bearish? Is it ranging? Structure does not predict the future. Remember that. No. Structure does not predict the future. It only helps us to understand the present. So we know that this is an uptrend in this particular scenario, right? So I know what the present is, and I'm only waiting. Okay, if this is an uptrend, that means the market should continue up until the market says otherwise. I'm looking for opportunity to be part of this uptrend. So structure does not predict the future. We're not trying to predict the future. We always say that whenever we're analyzing, that is not a prediction. It's just using the market story to guide us on what we want to do. It only helps us to understand the present. And when you combine market structure with liquidity, you will begin to see the market as institutions do. So you combine the market structure with the liquidity. If you go back to when we've started these classes, every every block is being put together to help us achieve something in a long run. And we need all those blocks put together to get a structure. So before every trade, don't ask yourself, where should I enter? What you should ask yourself is, what is the market structure? Is it a trend to the bullish or to the bearish? Then you ask yourself, where is the liquidity? That is what is drawing the market. That's what we call it, draw on liquidity. So is price moving towards that level? Yes. Or, there are two types of liquidity. We also put that together, but let's make this simple so that there won't be any confusion. So is price moving towards that liquidity? When you can answer those questions, you are no longer reacting to the market. No. If you are able to answer those questions, you will see clearly. That means you are reading the story that the market is telling you. Market structure tells you the story. Liquidity reveals the destination of that story. And we've talked about displacement. It's kind of a confirmation to the intent of what the market is about to do. That's the narrative we have in today's class. Market structure is something that you should put yourself together, learn, understand, and follow through. And we'll always tell you and leave you with this. It's not a signature, no. The advice is always learn to map liquidity first and learn to follow structure over speculation. That is what we have for you in today's class. And if this video has been of help to you in understanding market structure and every other thing, please do make a comment, do subscribe, and share. Remember, I will see you again in our next topic. Till then, be safe. Thank you.